Hi, so we're going to continue now our series on options income myths, and this is options income myth number 5, which would be spoken by somebody who's just getting started trading options. He's all excited about what he's heard. He's heard of this term options income trading, so he says to himself, well, I'm an options income trader now, so I'll make money every month and I'll just pay my bills with the income I make from my options trading. If only it were that easy. I don't really know where this term options income trading got started. My guess is it came from covered calls, which is probably a legitimate use of the term options income. If you own shares of a stock and you'd like to make some income on top of the dividends from that stock, then you can sell a covered call every month. And as long as you still own the stock, you'll be able to make some income on that stock in addition to the dividends, because you would make call premium from selling your calls against your stock. Now, you can have your stock, if the stock rallies and your covered call is in the money, it could get called away, in which case the game ends because you don't have those shares anymore. And by the way, you pay most likely a realized capital gain for that, so that's something to consider. But in any event, you could justify calling that options income trading because you will in fact make income from selling calls against shares that you own. And let's give you an example of what this looks like, just so that those of you who've never heard of a covered call will understand what I mean. If you sell the October, as of this morning, if you sold Google 960 call, Google was trading around 926 this morning, you would have received somewhere in the neighborhood of a $10 time premium for that. Well, everything in options is multiplied by 100, so that's really the equivalent of receiving $1,000 for selling that call. Now, if Google goes up to 960 and your shares get called away, well, game's over. You made some nice money on your shares, but you won't be able to sell covered calls in future months after that because you won't have the shares unless you go back out and buy them again. So covered call writing is in fact a form of what I would legitimately think can be called options income trading. But most of us in our online community, the options tribe, are not trading covered calls, or we're not doing very much of it. We're really trading what I prefer to call market neutral positive theta options trades. And these are trades which take advantage of the time decay of short options, but are predicated on the idea of the market moving in a kind of a reasonable range, in which case we'll most likely make money. And if the market moves outside of that reasonable range, then we'll most likely lose money or struggle to make a little bit of money, or maybe lose a little bit of money. But the point is, market movement dictates whether we will make money on a trade in any given month, which is not the case with a covered call. With a covered call, if you own the shares, you sell the call, you're going to earn the income from that call. Whether the implications of that are your shares get called away, that's another matter. But the bottom line is that in the type of trading that most Options Tribe members are doing, we're doing market neutral, positive theta trades, and you're going to lose some months. So let's take a look at what I would call the options income fantasy. Let's say you've come up with a strategy that on average, through your back testing, you've determined will make you $60,000 a year. Let's say you're getting a 30% return on $200,000. That's in the realm of possibility in options income trading. Excuse me, market neutral, positive theta income trading. Now, having said that, what is the likelihood that your cash flow will be as it is on this slide? $5,000 every single month, adding up to $60,000 at the end of the year. And I would say the chances of that are 0. All right? You may make $60,000, but a more realistic scenario is this slide, where you make money some months and you lose money in other months. At the end of the year, you end up with your expected $60,000, but it doesn't happen smoothly. It happens in such a way that some months you'll make a little bit of money, other months you'll lose a little bit of money, some months you'll make a lot of money, other months you'll lose a lot of money. At the end of the day, when you add it all up, it's the same total, but it comes in an uneven way. So what are the implications of this for you? Well, last time I checked, you can't go to the grocery store and buy your groceries with negative dollars. So if, for example, on this chart in the month of May, where you've lost money, what are you going to do? You can't rely upon the exact pattern of cash flow from your trading account to pay your bills with market neutral positive theta options trading. Instead, you have to realize that it's going to come in unevenly. So you can't pay your bills with a negative number, and therefore to call it income trading as though it's the same kind of income you'd receive from a bond or from Social Security or from a salary or some other form of steady income, it's just not income in the normal sense of the word. So what does it mean to you practically? What it means is that you may have a great strategy, but that strategy cannot be implemented if you have to reduce your capital level because in a particular month you've got to go pay your bills. You have to have a cash flow plan so that while you're accumulating your $60,000 that year, you are not forced to go into your trading account and reduce the capital level. Then you will never be able to earn the return that you're looking for. So it's key to having a cash flow plan in addition to having an options trading strategy in order to make this business of options trading work for you. So what's the moral of the story? Stop calling it options income trading and fooling yourself into believing that you are going to make money every single month. You will not. You're a market neutral, positive theta options trader. You're going to have losing months. You've got to have a cash flow plan to deal with that in order for you to continue in this game long term. Thanks very much, and we'll go over options myth number 6 next week. Thanks.